Welcome to This Explainer. Look, today we're tackling the holy grail of finance, the elusive, often totally misunderstood, and highly sought-after concept of alpha. We're going to dive into the hard data, separating true manager skill from pure random chance, and uncover the somewhat harsh mathematical realities of the market. If you've ever stopped to wonder what you're actually paying for when you hand your money over to an active manager, you are absolutely in the right place.
So, let's just cut right to the chase with a question you really have to ask yourself. When a fund manager consistently beats the market, are you paying top dollar for actual repeatable investment skill, or are you just buying incredibly expensive multi-million-dollar dumb luck? It's a question that has literally split Nobel Prize-winning economists, and today we're just letting the data speak for itself.
To get to the bottom of this, here's our roadmap for today's explainer. First, defining investment alpha. Second, skill versus random luck. Then, active share and concentration, followed by the threat of alpha decay, and finally, alternative alphas and allocation. Let's get right into it.
All right, Section 1, Defining Investment Alpha, the baseline vocabulary. You hear the word alpha thrown around constantly in this industry, right? But precision actually matters here. Alpha is a measure of the active return on an investment compared to a suitable market benchmark. But here is the absolutely crucial part. It's the performance after accounting for the assumed risk. Think of it kind of like a handicap in golf. You don't just look at the final score, you have to adjust for the difficulty of the course itself. A positive alpha means you are rewarded beyond the exact amount of risk you took on, while a negative alpha means you took on risk without getting the requisite reward. Now, this brings us to our main conflict. The efficient market hypothesis tells us that financial markets are basically hyper-competitive pricing engines. They digest all available information almost instantly. So if stocks are always trading at their fair value, then finding a consistent edge, a true repeatable alpha, is virtually impossible. This idea suggests that active investing is essentially a zero-sum game before costs, and a negative-sum game, well, after you factor in those incredibly high management fees. Which leads us to Section 2, Skill versus Random Luck, the master stock picker myth. Okay, we really need to draw a hard line here between genuine, repeatable manager skill that actually covers its own costs and random statistical variance that's just piggybacking on the broader market's beta. Remember, beta is just the rising tide that lifts all boats, and honestly, it is way too often confused for alpha. When you're looking at thousands of funds, some are bound to have extreme market-beating returns purely by chance. The real challenge, as Eugene Fama and Ken French famously pointed out, is separating the actual signal from all that noise. And this stat right here absolutely blew my mind. Researchers at Northern Trust analyzed a massive sample of 959 institutional equity funds to see how many produced statistically significant alpha. Statistically speaking, just by pure, dumb, random chance, you'd expect about 24 of those funds to show massive outperformance. But you know how many they actually found? 22. Yeah. In the right tail of performance, they found fewer winners than random probability predicted. Meanwhile, in the left tail, they found 119 funds producing statistically significant negative alpha. The harsh reality? If you're paying a premium for a hotshot stock picker, they are far more likely to drag your portfolio down with fees than consistently beat the odds. In fact, when you map out the actual distribution of mutual fund returns, it aligns almost flawlessly with a simulated curve of pure chance. I mean, once you factor in their hefty expenses, the vast majority of active funds simply do not possess enough skill to cover their own costs. They are, for all intents and purposes, living in a world governed entirely by random luck.
Moving on to Section 3, active share and concentration, the mechanics of edge.
So, for those exceptionally rare managers who do actually possess true skill, how does it work? Well, to generate excess returns, you absolutely cannot just hug the index. Research shows you have to deviate significantly from the benchmark's holdings. This is called high active share, and it is absolutely essential for magnifying outperformance. But remember, this is a massive double-edged sword. High active share magnifies outperformance for skilled managers, sure, but it just as intensely magnifies losses for unskilled ones. If you're gonna stray from the pack, you really better be right.
There's this really fascinating insight from JANA research on this. They point out that poor mutual fund performance often isn't actually about a lack of initial stock picking ability. Instead, it's institutional factors forcing managers to over-diversify. Driven by career preservation and a ton of pressure to mitigate risk, they end up picking stocks way beyond their actual best ideas. And ironically, that dilutes their true alpha-generating positions and pushes their portfolios right back into negative relative returns.
Let's hit section 4, the threat of alpha decay, a ticking clock.
Look, finding alpha is hard enough, right? But keeping it, that is a literal race against time. Data from Maven Securities shows the staggering cost of just being a little slow to trade. In a world where information travels at the speed of light, a predictive model loses its edge in moments. The cost of this alpha decay is massive. We're talking an average loss of 5.6% in US equities and nearly 10% in Europe if execution is delayed. When a trade gets crowded, the first few in take all the profit, and there's zero edge left for anyone showing up late.
And to make matters worse, Essentia Analytics highlights a massive behavioral pitfall, the endowment effect. Managers are human, They fall in love with their winning stocks, even when those stocks clearly stop loving them back. They hold on to them for emotional reasons, keeping them way, way past their alpha-generating prime. That single psychological bias typically costs portfolios over 100 basis points every single year.
This creates what we call the alpha life cycle. Analysis of real portfolios over a decade proves that alpha has a distinct beginning, middle, and end. There is an accumulation phase, a peak, and then a ruthless decay phase. On average, managers see a 400 basis point peak to trough decay on their positions. The absolute best managers in the world are the ones who understand this life cycle and ruthlessly recycle their capital before that decay turns into outright value destruction. Finally, Section 5, Alternative Alphas and Allocation, the New Paradigm. So, how do modern allocators actually survive all this? Well, the industry is undergoing a massive paradigm shift. We are finally moving away from that old, overly simplistic two-tier model that separated returns into just market beta and pure alpha. Based on the CIAI framework, we're entering a modern three-tier allocation model. The industry is waking up to the fact that a lot of what we used to pay a premium for as alpha is actually just alternative risk premiums, or alternative betas, that can be captured way more cheaply. This modern framework gives us a highly actionable checklist of alternative alphas. Instead of relying on the fairy tale of the master stock picker, modern managers are dynamically adjusting beta exposures, extracting illiquidity premiums from private markets, and strictly controlling specific risk factors. Sure, this requires a lot more skill than basic passive indexing, but it offers a much more realistic, structural path to excess returns. These are highly specialized skills we're talking about, like adjusting leverage based on market volatility, extracting illiquidity premiums from private equity, or using rigorous math to capture the size effect. These are the highly specific tools that actually justify active management fees today. It's not about guessing the future. It's about systematically extracting value. Ultimately, understanding the brutal math of the market, the absolute rarity of true skill, and the short lifespan of alpha really forces you to take a hard look at your own portfolio. So ask yourself, are your strategies built on outdated myths and incredibly expensive random luck? Or are you ready to structure your portfolio for the realities of modern alternative betas and true structural edge? Thanks so much for joining me for this explainer. Keep questioning the data. And seriously, never pay for luck.